One way to think about the AI revolution is that it's a process of dematerialization. You take physical inputs, factories, supply chains, human labor, and you replace them with digital code running in the cloud. But the reality, it turns out, is a bit messier. The cloud is not ethereal. It is a collection of very large, very hot buildings that require a shocking amount of energy to run and even more water to cool. And right now, nowhere is this physical reality more clear than in the state of Johor, Malaysia. In just a few years, it's become one of the hottest data center markets in the world, the physical manifestation of the AI boom. But this digital gold rush is pushing the region's resources to their absolute limit. According to a new report from CNBC, Johor's total planned data center capacity is nearly 10 times its current level. By 2035, the country's data centers are projected to consume 20% of its total electricity generating capacity. This local story highlights a global problem. Here's the real story. The AI revolution isn't a story about software, it's a story about physical infrastructure. And the insatiable demand for power and water has created a global policy paradox. You can have an unrestrained AI boom, or you can have climate goals, but it is becoming increasingly difficult to have both. To understand this collision between the digital and the physical, we need to deconstruct the global demand shock driving this crisis, trace the money trail behind the hyperscaler buildout, analyze the policy paradox it creates, and explore the new wave of innovation trying to solve it. Let's unpack this. The crisis unfolding in Johor is not an isolated event. It's the part of the demand shock that is pushing the limits of global physical infrastructure. To understand this shock, you have to understand the basic physics of a data center. At its core, every AI data center has two massive energy problems to solve. First, the compute. The specialized AI chips, or GPUs, that power this revolution are incredibly dense, consuming vast amounts of electricity to perform trillions of calculations per second. But every watt of electricity used for computing generates heat. And that creates the second problem, cooling. To prevent the servers from overheating and melting down, data centers must run massive industrial-scale cooling systems 24/7, which can consume almost as much power as the chips themselves. A modern AI data center isn't just a computer, it's a giant, energy-hungry refrigerator. And the scale of this energy consumption is staggering. According to a report from the International Energy Agency, in 2023, even before the latest AI models were widely deployed, the world's data centers already consumed as much electricity as the entire country of Germany. By 2030, the projected electricity usage by data centers will be comparable to the entire electricity consumption of India. In the United States, the world's largest data center market, the impact is even starker. A recent analysis from Carnegie Mellon University projects that by 2030, the growth in data centers could cause Americans' electricity bills to rise by 8% and drive a 30% increase in greenhouse gas emissions from power generation. And this isn't just a power crisis, it's also a water crisis. Many of these massive cooling systems rely on water, and some researchers estimate that by 2027, AI infrastructure could consume 4 to 6 times more water than the entire country of Denmark. This isn't a gradual, predictable increase our infrastructure can adapt to over time. It is a sudden, exponential demand shock, and it's being fueled by the single greatest corporate spending spree in history. By the way, deconstructing these physical supply chains and revealing the hidden costs behind the AI hype is the core of our analysis in the ARPU newsletter. We focus on the real-world infrastructure that underpins the digital revolution. If you want to get this level of strategic insight sent directly to your inbox, you'll find the link right at the top of the description. So, who is fueling this demand shock? The answer is an ecosystem of capital with a handful of technology titans at its center. The primary engine of this global build-out is a small group of hyperscalers. According to a new research report, these companies are the primary architects of the boom, deploying unprecedented levels of capital to fund their own AI arms race. The numbers are staggering. Amazon plans to invest over $100 billion in 2025. Microsoft is on track for $80 billion. Google has allocated $75 billion, and Meta has raised its forecast to $72 billion. This colossal spending not only builds their own capacity, it creates the predictable large-scale demand that underpins the entire investment market. But the hyperscalers are not building this alone. A class of financial investors is also ready to fund and execute this new industrial revolution. At the forefront are specialized private equity and infrastructure funds like Blackstone, KKR, and Digital Bridge. These funds act as the new kingmakers, acquiring and developing data center platforms at a massive scale. Blackstone's strategy is defined by immense scale and vertical integration. After its $10 billion acquisition of data center operator QTS, it pioneered a landmark $25 billion joint venture in Pennsylvania with the utility provider PPL, a deal designed to build not just the data centers, but also the dedicated power plants required to run them. KKR is executing a similar strategy, forming a $50 billion partnership with power generator ECP to deliver integrated solutions. And Digital Bridge is backing some of the most ambitious projects on the frontier, including Vantage's colossal $25 billion 1.4 gigawatt Frontier mega campus in Texas. And underpinning this entire structure are the vast, patient capital pools of the world's largest institutional investors. Sovereign wealth funds like Singapore's GIC and public pension funds like the Canada Pension Plan Investment Board are deploying billions through joint ventures, providing the long-term capital these mega projects require. The corporate ambition of Silicon Valley, financed by Wall Street and global pension funds, is now a physical problem for the rest of the world. This collision between the digital and the physical creates a fascinating and unavoidable policy paradox for governments. The race for AI dominance is now in direct conflict with the push for sustainability. Two competing strategies are emerging, and they are moving in opposite directions. On one side, you have the unrestrained boom strategy, best exemplified by the United States. President Trump's America's AI Action Plan is a direct call for deregulation. It aims to accelerate the build-out by streamlining permitting and removing environmental regulations for data centers and the power plants they require. For the U.S., winning the AI race is the top priority, even at a potential environmental cost. On the other side, you have the sustainable framework strategy. Nations like Singapore and Malaysia, having experienced the resource strain firsthand, are trying to rein it in. They are launching initiatives like the Green Data Center Roadmap and a Sustainable Data Center Framework, policies designed to optimize energy efficiency and push the industry towards renewables. This creates a powerful dynamic of regulatory arbitrage. In 2019, when Singapore imposed a 3-year moratorium on new data centers to manage the strain on its grid, the industry didn't stop building. It simply moved across the causeway to the friendlier regulatory environment of Johor. Capital fled the constraints, flowing to the path of least resistance and creating the very crisis in Malaysia that we see today. This is the global dilemma. If one nation imposes strict environmental rules, the multi-billion-dollar investments simply move elsewhere. This has ignited an intergovernmental competition, pitting national economic ambitions directly against global climate goals. And so far, there is no consensus on which should win. A physical bottleneck of this scale creates an enormous business opportunity. And in response, the market is now generating two distinct and competing strategies to solve the AI power crisis. The first strategy is decentralization. Instead of waiting in 10-year queues for the national grid, companies are pioneering a model of smaller, self-contained, and rapidly deployable AI data centers. An example of this approach is the partnership between the data center startup Crusoe and Redwood Materials. Their model is to build off-grid facilities, powered by dedicated renewable sources like large-scale solar paired with energy storage from recycled EV batteries. This strategy is a direct bet on speed and flexibility, aiming to bypass the gridlock of traditional infrastructure entirely. The second strategy is re-centralization, but with a new power source. And this isn't just a niche idea from startups. It's being bankroled by the biggest names in technology. In 2024, Microsoft announced a $1.6 billion deal to restart a reactor at the infamous 3 Mile Island nuclear plant. As the CEO of the plant's owner, Constellation Energy, explained, Microsoft needed a source of reliable, clean energy for 20 years to meet its AI and net zero goals, a demand that intermittent renewables alone couldn't satisfy. Weeks later, both Amazon and Google announced their own major investments in nuclear energy, striking deals with startups like Kairos Power and X Energy to build a new generation of small modular reactors, or SMRs. The thesis is that these compact reactors can be built next to data centers, providing a dedicated zero-emission power source that runs 24/7, the base load power that massive AI workloads demand. But this big bet is not without its skeptics. As Professor Sharon Squassoni told CBS News, there's only one problem with small modular reactors: they don't really exist. What she means is that SMRs are not yet a proven, commercially available technology. They are still in the prototype and licensing phase, years away from being connected to the grid. She warns that the tech giants may find the process way too long and way too expensive, and that this could be a case of tech bro overconfidence. Decentralized renewables versus next-generation nuclear. These competing visions for powering the future of AI are now driving a parallel revolution in energy and industrial technology, creating a new and highly speculative investment landscape. This intense focus on power, water, and land is more than just an engineering problem. It is reshaping the economics of the entire AI industry. For years, the cost of AI was dominated by two things: the immense R&D spending to develop new algorithms and the high price of the specialized chips themselves. But now, a third and potentially larger cost is entering the equation: the long-term operational expense of physical infrastructure. The ongoing cost of electricity and water to run and cool these massive AI factories is becoming an important factor in the total cost of ownership. This is a profound shift from a software-centric to an industrial cost model, and it also implies that only the hyperscalers have the financial scale to implement it. This new reality is also rewriting the rules of geographic competitiveness. A nation's or a region's ability to provide cheap, abundant, and reliable power is quickly becoming a primary competitive advantage in the global AI race. And this is beginning to flip old economic assumptions on their head. Startups in the space are now pitching a new value proposition: the idea of a negative green premium. The argument, as articulated by the CEO of off-grid data center company Crusoe, is that decentralized, renewable-powered solutions can be not just faster to deploy, but in some cases cheaper than grid power in a market like Northern Virginia. This signals a future where sustainable, decentralized infrastructure isn't a green tax, but a direct competitive edge. The most successful AI companies of the next decade won't just be the ones with the best algorithms, they will be the ones who have mastered the brutal physical supply chain of energy and resources. So, after examining the evidence, we return to the central paradox of the AI revolution. The technology was promised as a weightless, digital force that would dematerialize our economy. Instead, it has revealed itself to be a deeply physical, industrial buildout defined not by the elegance of its code, but by the brute force of its physical footprint. This collision between the digital and the physical is just beginning. To track its evolution, you don't need to be an energy expert, you just need to watch the business signals. Here are the 4 key metrics that will tell you where this is heading. First, watch the price of power in key data center hubs. Monitor the electricity and water tariffs in established markets and emerging ones. Any significant, sustained price increase is a direct indicator of the growing physical strain. Second, track the power purchase agreements, or PPAs, of the tech giants. Are Microsoft, Google, and Meta signing more deals for intermittent renewables, or are they making bigger, longer-term bets on baseload power from nuclear? Their capital allocation will reveal their long-term energy strategy. Third, follow the permitting pipeline. Watch for changes in government policy regarding the approval of new data centers and power plants.
Will more nations adopt the deregulatory approach of the U.S. AI Action Plan, or will the sustainable frameworks of Singapore become the global standard? And finally, monitor the enabler companies. The performance of the businesses that provide the physical infrastructure, from industrial power companies to innovative startups building off-grid solutions, will be a direct measure of the health and scale of this AI build-out. Understanding how the digital world is constrained by the physical world is crucial to navigating the business of tech. This kind of deep dive analysis is what we do every week in our newsletter, ARPU. If you want to understand the real supply chains and cost structures behind the headlines, you'll find the link in the description. Thanks for watching.